Ladies and gentlemen, Asian guy here. I need you to stop scrolling. I need you to close the other tabs and focus on what I'm about to tell you, because the most powerful governments on earth just made a move that changes everything. They didn't announce it. They didn't hold a press conference. They didn't even try to hide it. They just quietly, methodically, surgically dumped hundreds of billions of dollars worth of U.S. Treasury bonds. And the terrifying part is that nobody is talking about it. The mainstream media is silent. The financial networks are pretending it's not happening. But the data doesn't lie. According to the latest Treasury International Capital reports that were just released, 5 major nations have been systematically liquidating their U.S. debt holdings at a pace we haven't seen since the 2008 financial crisis. We're not talking about small adjustments. We're not talking about portfolio rebalancing. We are talking about a coordinated exit from the dollar system. And if you understand what U.S. Treasuries actually represent, if you understand that they are the foundation of the entire global financial architecture, then you know what this means. The foundation is cracking. The pillars are being removed. And the question isn't if the structure collapses. The question is when. Let me give you the numbers because this is where it gets real. China has reduced its treasury holdings by $87 billion over the last 6 months. Japan, the largest foreign holder of U.S. debt, has quietly sold off $63 billion. The United Kingdom, which many people don't realize is actually a proxy hub for Middle Eastern sovereign wealth funds, has dumped $42 billion. Saudi Arabia has reduced its position by $28 billion. And here's the one that should terrify you. France has liquidated $31 billion in U.S. government bonds in the last quarter alone. Add it all up, that's $251 billion in treasury liquidations in 6 months. That is not normal market activity. That is not a coincidence. That is a deliberate, strategic retreat from the U.S. dollar. These are not retail investors panic selling. These are central banks. These are finance ministries. These are the people who sit in rooms with no cameras and decide the fate of currencies. They have decided that holding U.S. debt is no longer worth the risk. Now, the question you should be asking is why? Why now? Why are these 5 governments who have spent decades accumulating treasury bonds as the safest asset on the planet suddenly running for the exits? To understand that, we have to go back to what happened in 2022. Most people remember 2022 as the year inflation exploded and the Fed started hiking interest rates. But something else happened that year. Something that didn't make the front page of the Wall Street Journal but sent shockwaves through every finance ministry on earth. The United States government seized $300 billion worth of Russian foreign reserves. Let that sink in for a moment. Russia had parked $300 billion in U.S. treasuries and Western bank accounts as a rainy day fund. And when the war in Ukraine started, the U.S., the EU, and their allies simply pressed a button and froze those assets. They didn't ask permission. They didn't need a trial. They weaponized the financial system. And every other country with treasury holdings watched that happen and thought the same thing. If they can do that to Russia, they can do it to us. This is the moment the world realized that U.S. treasuries are not actually risk-free. They are only risk-free if Washington likes you. The second you step out of line, the second you make a foreign policy decision that contradicts U.S. interests, your reserves can be frozen, seized, or turned into leverage against you. And this changes the entire calculation for holding dollars. Suddenly, owning U.S. debt isn't about getting a safe return. It's about maintaining a hostage situation where you are the hostage. So what did these governments do? They started diversifying. They started moving their reserves into gold. They started building bilateral trade agreements that bypass the dollar. They started creating alternative payment systems. And most importantly, they started selling their treasuries before the rest of the world figures out what's happening. Let's talk about China first, because China is the canary in the coal mine. For 2 decades, China was the biggest buyer of U.S. debt. They recycled their massive trade surplus into treasury bonds. It was a symbiotic relationship. America got cheap goods and cheap financing. China got export-driven growth and a stable place to park their dollars. But that relationship is over. China's treasury holdings peaked at $1.3 trillion in 2013. Today, they are down to $816 billion. That's a 37% reduction. And the pace of selling has accelerated. Why? Because China sees what's coming. They see the U.S. national debt spiraling past $36 trillion. They see the interest payments on that debt eating up more than $1 trillion a year. They see a government that cannot stop spending, and a Federal Reserve that will eventually have to choose between letting the bond market collapse or printing money to buy the bonds themselves. And China has decided they don't want to be holding the bag when that choice gets made. So they are converting dollars into real assets. Gold reserves, strategic commodity stockpiles, Belt and Road infrastructure, and domestic consumption growth. They are moving from paper wealth to hard wealth. And they are doing it as fast as they can without crashing the treasury market and destroying the value of the dollars they still hold. Japan is even more fascinating because Japan is supposed to be America's closest ally in Asia. They have U.S. military bases on their soil. They are part of the security umbrella. And yet, they are quietly backing away from treasuries. Why? Because Japan has its own debt crisis. Their debt to GDP ratio is over 260%. They have been running deficits for 30 years. But the moment the yen started collapsing in 2022, dropping from 110 to the dollar all the way to 150, Japan had a choice. They could either defend the yen by raising interest rates and crashing their economy, or they could sell U.S. treasuries to buy yen and stabilize the currency. They chose the latter. The Bank of Japan has been liquidating treasury bonds to intervene in the currency market. Japan is trapped, and their only way out is to keep selling treasuries, which means they are no longer a reliable buyer of U.S. debt. Now let's talk about the United Kingdom, because this is where it gets murky. The UK is listed as the third largest holder of US treasuries with over 700 billion, but most of that isn't actually British money. London is the offshore parking lot for Middle Eastern oil money, Russian oligarch money, and Chinese corporate money that wants to stay anonymous. When the UK sells treasuries, it's often a proxy for someone else making the decision. And right now, the Gulf states are making a very specific decision. They are moving away from the petrodollar system. For 50 years, Saudi Arabia, the UAE, and Kuwait have recycled their oil revenues into U.S. treasuries. It was the deal. They sell oil in dollars, and they invest those dollars in U.S. government bonds. But that deal is breaking down. Saudi Arabia is now accepting payment for oil in yuan. They are joining BRICS. They are building sovereign wealth funds that invest in Asian infrastructure, European real estate, and African mining projects. They are diversifying away from dollar dependence. And the $42 billion in treasury sales coming through London is the visible tip of that iceberg. Saudi Arabia itself has reduced its official treasury holdings by $28 billion, and this is the country that has been America's anchor in the Middle East for half a century. The fact that they are pulling back from treasuries is not just a financial decision, it is a geopolitical signal. It says that the Saudis no longer believe that their security is guaranteed by holding U.S. debt. It says they are preparing for a world where the U.S. is not the dominant hegemon. And if Saudi Arabia is preparing for that world, every other oil producer is watching and learning. And then there's France. France liquidating $31 billion in treasuries is the wild card that nobody saw coming. France is a NATO ally. France is a G7 member. France is part of the Western financial establishment. So why are they selling? The official explanation is that France is repatriating capital to deal with domestic fiscal pressures. But there's a darker explanation. France, and by extension the European Union, is starting to realize that the US is no longer a reliable partner. The US blew up the Nord Stream pipeline, destroying Europe's cheap energy supply from Russia. Europe is waking up to the fact that America will prioritize its own interests over allied interests every single time. And if that's the case, why should Europe keep lending money to the US government at 4% interest when they could be building their own industrial base? So here's what we're really looking at. These 5 governments, China, Japan, the UK, Saudi Arabia, and France, represent different pieces of the global order. China is the manufacturing hub. Japan is the developed Asia anchor. The UK is the offshore financial center. Saudi Arabia is the energy kingpin. France is the European core. And all 5 of them are simultaneously reducing their exposure to US treasuries. This is not a coincidence. This is a coordinated de-risking. They are not sitting in a room together plotting the end of the dollar. They don't have to. They are all reading the same balance sheet. They are all seeing the same debt trajectory. They are all watching the same political dysfunction in Washington. And they are all coming to the same conclusion. The U.S. government is on an unsustainable path. The people holding U.S. treasuries, when that path ends, are going to lose money. Now, what does this mean for the average person? What does it mean when foreign governments stop buying U.S. debt? It means that the U.S. government has to find someone else to buy it. And there are only 3 options. Option 1, domestic buyers. U.S. banks, pension funds, and insurance companies buy more treasuries, but they are already stuffed to the gills. Banks are sitting on hundreds of billions in unrealized losses from treasuries they bought at low rates. If they buy more, they increase their risk. Option 2, higher yields. If foreign demand dries up, the U.S. government has to offer higher interest rates to attract buyers. But higher rates mean higher interest payments on the national debt, which means bigger deficits, which means more borrowing, which means even higher rates. It's a debt spiral. Option 3, the Federal Reserve steps in and buys the bonds itself. This is called monetizing the debt. It is money printing. And it is the road to currency collapse. The Treasury market is the deepest, most liquid bond market on the planet. It is the foundation of the entire financial system. Mortgage rates are priced off treasuries. Corporate bonds are priced off treasuries. The dollar's value is tied to the demand for treasuries. If that market breaks, if buyers disappear and the Fed has to step in as the buyer of last resort, the dollar loses its credibility. And once the world loses faith in the dollar, it loses faith in U.S. Treasuries. And once it loses faith in U.S. Treasuries, the entire architecture of global finance collapses. We are not talking about a stock market correction. We are talking about a sovereign debt crisis in the country that prints the world's reserve currency. And here's the part that should keep you awake at night. The U.S. government is currently running a deficit of over $2 trillion a year. That means they need to borrow $2 trillion every single year just to keep the lights on. If foreign buyers are pulling back, if China is selling $87 billion, if Japan is selling $63 billion, if the Saudis are selling $28 billion, that's $178 billion in demand that just evaporated. Who fills that gap? The answer is that nobody fills it voluntarily. The market fills it by repricing, yields go up, prices go down, and everyone holding treasuries takes a loss. This is why the Fed is terrified. This is why they are walking a tightrope between fighting inflation and keeping the bond market stable. If they raise rates too high, they crash the treasury market and trigger a sovereign debt crisis. If they cut rates too soon, inflation comes back, and foreign holders dump treasuries even faster to protect themselves from currency debasement. We are watching the slow-motion unraveling of the post-1971 financial order. When Nixon took the dollar off gold, the deal was that the world would accept dollars as payment because those dollars could be invested in safe, liquid U.S. Treasury bonds. The Treasury market was the safety valve. It was the place where surplus dollars went to sleep. But that valve is closing. The world is waking up to the fact that U.S. Treasuries are not safe. They are only safe until Washington decides they're not. And once that perception breaks, once the world stops trusting U.S. debt, the dollar loses its reserve currency status. And when the dollar loses reserve status, the U.S. loses the ability to print money and export inflation to the rest of the world. We become a normal country with a normal currency and a very abnormal debt load. So what happens next? Watch the Treasury auctions. If the U.S. government struggles to sell bonds, if they have to offer higher yields, that's the signal. Watch the Fed's balance sheet. If it starts expanding again, if they start buying treasuries, that's the signal. Watch gold. If central banks keep buying gold at record pace while dumping treasuries, that's the signal. And most importantly, watch the countries that are staying quiet. India hasn't made a move yet. Brazil is watching. Indonesia is watching. If they start selling treasuries too, if this becomes a stampede, there will be no stopping it. The dam will break, and the flood of dollars coming back to the U.S. will drown the currency in inflation. The 5 governments unloading treasuries right now are not doing it because they hate America. They are doing it because they are reading the math. And the math says that the U.S. government cannot service its debt without debasing the currency. So they are getting out while they still can. They are moving into hard assets, gold, commodities, land, infrastructure. They are preparing for the world after the dollar. And if the smart money is preparing, you should be too. This is not a prediction. This is not speculation. This is data. $251 billion in treasury liquidations in 6 months. That is the sound of confidence leaving the system. Stay alert.